Hi, my name is Derek Miller, and welcome to our new series, SF Conversations. I'm joined by Stephen Yaeger and Christine Yoon, both from Fitch's Structured Credit team. Today, we are going to have a brief conversation about CLO market and rating trends. So let's get started. Christine, we'll start with you. Can you tell us a little bit about Fitch's rating performance for CLO notes historically and how they fared?
So Fitch rating performance have been vastly stable on USBS CLO notes that's been issued since 2010. So if we took a look at the current ratings outstanding on the nearly 3,000 tranches under our surveillance, we've seen, and compare them to the original rating levels, we've seen a handful of downgrades and over 30 upgrades. And so if we think about defaults, we haven't yet seen a Fitch-rated note experience default since 2010. And if we go all the way back to notes that were issued before the financial crisis 2008, we've seen low single-digit defaults on the single B rating level.
Okay, that's interesting. Thanks for that. With respect to CLO notes and assigning ratings to those notes, under that methodology, is there certain assumptions or key parameters that we're looking at when we assign ratings? Steve?
Yes, so there's really two overarching principles in our criteria when we're assigning ratings. The first is that senior investment grade rated notes, particularly AA and AAA, should see limited rating action or risk of a downgrade through peak default cycles. And then the second related principle is that at the single A rated category, those notes should be able to withstand peak default rates observed historically while also assuming trough recoveries. So again, single A can withstand peak defaults with trough recoveries, and AA and AAA in excess of that.
Okay. And Christine, how about the key rating drivers that are behind the rating methodology? I think we have 5 of those. So can you tell us a little bit about those and how those fit into the ratings?
Sure. So namely, the key rating drivers would be asset credit quality. So we would look at the issuer default rating of the corporate obligation. We would also consider the asset security, which determines, we look at the seniority level of the obligation as well, which determines the recovery assumptions that we use. And then there's portfolio management, portfolio composition, as well as cash flow analysis, which incorporates the structural features of the CLO.
Okay. And Steve, back to you. When we're assigning new ratings to CLO notes, how do we look at those portfolios and the structure? What are the specific approach that we take when we stress the transaction?
Right, so when we're assigning new ratings, a big focus of the analysis will be on the portfolio of assets and generating default and recovery expectations from those. But most CLOs have a reinvestment period where the manager is free to trade within certain limits and covenants. So in addition to analyzing the closing portfolio, we'll also generate a stressed portfolio to kind of gauge the potential negative impact of reinvestment. And so, as Christine was saying, in our key rating drivers, we'll look to the key covenants that relate to asset credit quality, seniority, portfolio diversification, and the risk horizon of the transaction, and stress for those limits and maximize them.
Okay, thanks for that. It's very insightful. We've also noticed transactions where they have credit quality metrics, security recovery metrics linked to a Fitch value. So a Fitch weighted average rating factor, a Fitch weighted average recovery rate, or a Fitch weighted average spread. Can you tell us a little bit about how transactions incorporate those features and what we're seeing in the market?
Sure. So some transactions have Fitch collateral quality tests, and as you were saying, those include Fitch weighted average rating factor, weighted average recovery, and weighted average spread. And those will fit into a Fitch test matrix. So in order to trade, the manager will also be subject to a Fitch test matrix. A typical matrix has 300 to 400 points that the manager can choose from, and they can also interpolate between them. Now, some deals will have a single matrix that's applicable at closing for the life of the deal. Others could have multiple matrices that have other parameters or covenants included. Some typical ones are that you could have a second matrix that's applicable when the weighted average life value reaches a certain limit or level, and you could have others that have stricter limits or covenants, such as we've seen some with stricter obligor concentration limits. And then, given that there's these covenants in the deal, the manager generally at closing will look to have some cushion to these covenants, so it doesn't limit their trading initially. And we've kind of seen managers go about this in different ways. So some managers like to have lots of cushion on recovery and be a little tighter on spread and rating factor, while some others will have 1 to 3 points of cushion on rating factor and recovery, and also just a little bit of cushion on spread. And from our perspective, Fitch doesn't require any certain amount of cushion. During our analysis, we'll look at all possible matrix points across all matrices and make sure the notes can withstand their rating stresses.
Okay, that's helpful. So you're looking at every point in the matrix and analyzing the stress versus the transaction. In addition to that, you mentioned interpolation. So there's interpolation within the CLO collateral quality test matrix, but I think we've also seen recently transactions where they're interpolating between multiple matrices throughout the transaction's life. Can you tell us a little bit about how that works?
Sure, there's been some recent transactions where there are multiple matrices, particularly based on the weighted average life schedule. And the manager has also had the option to interpolate between those matrices. So if you have a matrix that's applicable at closing, another one that's applicable a couple years later, if you're in between those two life points, the manager can interpolate those matrix cases.
Okay, that makes sense. Thanks, Steve. Christine, to you. Steve talked a little bit about our process and approach for assigning new ratings. Are there key assumptions or key differentiations in terms of factors that we're using when we're surveilling CLO note ratings versus assigning new ratings?
I would say the main difference between assigning new ratings and actually surveilling the ratings is that we are, any rating action we take would be based on the performance of the actual portfolio and not on some hypothetical or potential case. Throughout the life of a CLO, you could see, the portfolio breach a collateral quality test or a concentration limit. But oftentimes there are mitigating factors in this CLO performance where, those negative impacts are being mitigated by more of the positives. So you could still see that there's still room on other tests and other limits as well. The coverage test might still have a lot of room as well. So, we incorporate this and we update our cash flow analysis. Our surveillance process will look at it on a weekly basis. And, it's very evident that even if you have a breach in a covenant or a test limit, you still see a lot of break-even default rate cushions on your rating stresses. And, it doesn't always necessarily mean a downgrade.
Okay, thanks for that. Are there any indicators that market participants can observe or look at when they're trying to ascertain whether Fitch is going to take rating action, either positive or negative on a CLO note?
Yes, so we do. So I guess the most direct way investors could look at is, we do offer and we do provide our model results to our website, and investors can actually look at where model implied ratings are coming out at each rated note. Model implied ratings just basically means the highest achievable rating that note could achieve based on that current portfolio analysis. So, if investors can compare where they are, they can try to ascertain the probable rating performance over time. We also publish cushions on our rating stresses. So cushions can be very meaningful as far as stability and if there's any downward pressure on that rating. For example, if I were to take our median AAA rating, and right now we're seeing it around 12% cushions. If I were to translate that to the credit quality of a portfolio, that's enough cushion to withstand a portfolio that has an average rating of a double B. And if that portfolio were downgraded to single B, those AAA notes would still be able to withstand that stress.
Okay, thank you for that, Christine. And thank you both, Steve and Christine, for your help today in answering these questions. Very insightful. Thanks for joining us today. If you have any questions or would like to continue the discussion, please send us a note at the address on the screen. Thanks for watching.